Okay. But this one takes time to dry. It's not like gel for maybe like next time we should have tried to look, I believe. Yeah. What do you call the name? Let me start. Nail scope. I think you took a picture of it the last time.
People have logged in. But young
Wait,
it's
class.
Yes, so.
Is it master program?
No, I can.
This one.
That's the one you go for.
No, I do physical. There's a school here. They have lectures in this.
Why did I kind of not?
We already have exemption, so
That
I won't just
10,000
discover them. We just got.
was for me.
Yeah.
If I want to go to is it if you are going to go, they give you the no, like that that's transport 2,500 per week now. So it's every week, 4 times a week is 10,000. So me, that's if I want to go from my house to that place, that's 10,000 is 5 months transportation. Because I don't check and come back. Most times, maybe 2 or 3 times, I just check to work. More larger time, I enter transport. 100 naira. Is that we'll go to tomorrow? We'll not analyze it very sweet. We'll not analyze it very well. Unless you want it virtual. We'll do virtual.
How would they take that decision? You that stays close to office.
You will find a way.
Cannot decide that and stand by it because it won't work.
It will not work.
But that's one thing I don't like.
Is this the answer or is there something?
But he sent a link.
Yeah, something. I'm not on mute.
You're not mute. What
Just notice it.
Everybody is even saying that.
Good afternoon, class. Good afternoon.
Afternoon, sir.
Yeah,
Yeah, good
this
afternoon,
is
sir.
a combined class for online and physical class for our VI students. The solo student too. The solo student too can join. So for the online students, have we discussed base erosion profit shifting?
No, we have not.
I'm
Okay.
normally
So on, I think we had lecture yesterday for online. Now we did pioneer legislation, Abby.
Yes.
Yes, sir.
Okay, that pioneer legislation will continue again next week Monday, because this is a combined class. I'm going to do some really what I intend to discuss today is unwritten and is part of the international tax. I will first discuss base erosion profit shifting. After base erosion profit shifting, I will now move to tin capitalization. After tin capitalization, I will now move to tax haven. After that, if time permits, I can now discuss tax evasion and avoidance. So by next week Monday, we continue from where we stop on pioneer legislation for our online students. So that is that. So for base erosion profit shifting is one of the international
good afternoon,
tax
sir. Good afternoon, sir.
policy. Good afternoon.
This is Juliet. For Isola, we've
Okay.
done base erosion profit shifting now.
Oh, you are done base erosion profit shifting in a solo.
Yes.
Yes. Okay, my VI for VI student have not done that. Online student too have not done that. I will start with base erosion profit shifting. So for those of you that are in solo, maybe you can use it as a recap. After finishing base erosion profit shifting, I will move to think capitalization and tax haven. Those two topics you have not done it in solo.
Yes, yes.
So, but I want to start with base erosion profit shifting.
Okay,
That
sir.
is what I want to start. Yeah.
Hi, sir. For the
So
online, can you please help us share the material on the group?
I've shared the material.
Okay.
So what is base erosion profit shifting? Like I always said, it's part of the international tax issues. Part of the international, because our topic, our advanced tax cost outline, we divide it into 4 parts. One of the parts that have 25 mark, we call this international tax. One of them is double taxation. What do you say? Please try to mute your audio. Please try to mute your audio. So one of the international tax is double taxation. Another one is taxation of non-residents, followed by transfer pricing, followed by base erosion profit shifting, followed by tax haven, followed by tin capitalization. Please. Please, a class is going on. Let's try to mute our audio. You are distracting the class, please. So we have about 7 international tax issues, which at least 2 of the 7 questions will come out from the two of those 7. 30-mark question is going to come out on international tax. Number 1, international tax, like I said, double taxation relief, taxation on non-resident, transfer pricing, base erosion profit shifting, tax haven, tin capitalization, current issue in international tax. So today we are going to look at base erosion profit shifting. What is base erosion profit shifting? It's a corporate tax planning strategies used by multinational company. A corporate tax planning strategies used by multinational companies to shift profits from higher tax jurisdiction to a lower tax jurisdiction. A planning strategy used by multinational company from high tax jurisdiction that is base erosion profit shifting. Techniques that companies use, especially multinational company, they will shift their profits from high tax jurisdiction to lower tax jurisdiction with the means of not paying tax or reducing their tax liability. Base erosion profit shifting is one of the tools of tax avoidance strategies used by multinational company. They want to use it to reduce their tax so that they will shift their profits from the country that normally collect tax or the company that charge high rate of tax to a country that give tax incentive or to a country that charge lower rate of tax. So multinational companies use base erosion profit shifting specifically for the purpose of reducing their tax liability in a country where they normally charge tax. So it is a tax avoidance strategy. They want to use it to avoid tax. So it's not an evasion, it's an avoidance. So what is the benefit of base erosion profit shifting to the company? What benefit with base erosion profit shifting? What benefit will a company derive from base erosion profit shifting? What benefits? According to OECD, base erosion profit shifting, adoption of base erosion profit shifting will result into this following benefit to a company, especially multinational company. Number 1, reduction of both corporate taxes and withholding tax in the source country. Reduction of both corporate taxes and withholding tax in the source country. What this one means is that base erosion profit shifting will result into reduction of corporate taxes. Company will pay low tax by practicing base erosion profit shifting because part of their profits that they need to pay tax on have been shifted to another country that charge nil tax or lower tax. Another one is reduction of taxes on any intermediary entity that receive amounts from the entity in the same source country. Base erosion profit shifting will reduce intermediary tax arising between multinational company, tax between parent and subsidiary, tax between associates and their fellow associates. Base erosion profit shifting will reduce it. Reduction of taxes on ultimate parents. That parent company that is in another country, the taxes that they're supposed to pay because they have a subsidiary and they can ship profit to the subsidiary country, that taxes will be reduced. What are the techniques of base erosion profit shifting? What techniques do you use for base erosion profit shifting? Number one techniques used to practice base erosion profit shifting is through the use of trademark and technology license. The use of trademark and technology license. Multinational company, they will sell trademark for their subsidiary. This our subsidiary every year for using our trademark or for using our software to prepare your report, or for using our software to sell your good. Every year you will be paying us certain amount called trademark license or technology license. As a result of that, multinational companies using this to reduce the profit of their subsidiary. They don't want their subsidiary to pay too much of tax. They are now charging them trademark license. You know, trademark license or technology license will be classified as an expenses in the account of the subsidiary. So it will reduce their tax liability. That means using trademark, they have shift profits from the subsidiary country to the parent company. Maybe the parent company, their own country, they charge lower tax, or they can shift the profit to another fellow subsidiary country, like another country that charge lower tax, like Malaysia, Qatar. Another techniques used by company to practice base erosion profit shifting is through the use of think capitalization. Through the use of what? Think capitalization. What do we mean by think capitalization? Most of the multinational companies, they will borrow their subsidiary loan. That loan that they borrow their subsidiary, they will charge interest. Why? That subsidiary, the loan he borrowed, he may not use the loan for any purpose. So the loan may be in his bank account. But for multinational company, for the parent to reduce the tax of the subsidiary, they will deliberately borrow them a loan. So that every year, they will not be saying they are paying interest on loan, on this loan given to them by their parent company. So, you know, an interest on loan is an allowable expense. It will reduce their tax. So it is a base erosion profit shifting. It is a tax planning strategy. It is a tax avoidance techniques. Another one, hybrid mismatch arrangements. Hybrid mismatch arrangements. This one is also used by multinational companies to practice tax avoidance, to practice base erosion profit shifting. By deliberately asking their subsidiary to pay for a transaction which is tax deductible. Another one, putting the assets into entity without substances. Putting the assets into entity without substances. Multinational company can practice tax, can engage in tax evasion and avoidance. By leasing an asset to their subsidiary.
Yeah.
They will lease asset to the subsidiary. They will say this subsidiary will lease this asset to. Every year, you will be paying us lease cost for the assets. That lease cost that the subsidiary is paying indirectly is reducing the tax liability of the subsidiary. Indirectly, it is reducing the tax liability of the subsidiary. So putting asset into entity without substance, they will give subsidiary an asset, and that asset is not owned by the subsidiary. They will lease the asset to the subsidiary, and they will be charging the subsidiary a lease cost. So those are the techniques used by multinational companies to practice base erosion profit shifting. Trademark or technology license, team capitalization, hybrid mismatch arrangements, putting assets into entity without substance. Another technique, transfer pricing, which I failed to mention here. Some companies use transfer pricing to practice base erosion profit shifting. They will send goods to the subsidiary, and that good that they send to the subsidiary, they will add a profit margin that is unreasonable. And in the subsidiary account, it will be cost of sales to the subsidiary. And you know that cost of sales is an allowable expense. That cost of sales, since it's unreasonable, it will reduce the tax liability of the subsidiary. So those are those techniques used by multinational companies to practice base erosion profit shifting. What are those measures put in place to reduce base erosion profit shifting, or recommendation made by OECD against base erosion profit shifting? What action OECD have taken in the past to reduce base erosion profit shifting? What recommendation does OECD recommend that will reduce the practice of base erosion profit shifting? You know, OECD, they are the international tax regulator. They are the ones that regulate and issues that have to deal with international tax. So they have put in place some measures that will reduce base erosion profit shifting. One of those measures is restriction of interest. Restriction of what? Interest. Anytime a company practices capitalization, we need to restrict the interest. We need to restrict it. We will not allow such company to deduct all that interest arising from the loan. We will restrict the interest. What is the rule of restriction of interest? We restrict the interest to 30% of any before interest, tax, depreciation, and amortization. So that once we restrict this interest, there will be available profits to the company that they can pay tax on. And anytime an interest is restricted, that unrelieved interest can be carried forward. That restricted interest can be carried forward for maximum of 5 years. Another techniques used, another measures or action guide against base erosion profit shifting is through the use of counter harmful tax practice. The relevant tax authority of each of the country, them too, they should be practicing harmful tax practice. They should be practicing counter harmful tax practice. That anytime your profit or your income is going out of Nigeria, you need to pay additional tax. Or we need to investigate where that income is going to determine whether appropriate tax have been collected from the country the income is going. Prevention of tax, artificial avoidance of permanent establishment. Prevention of artificial avoidance of permanent establishments. It's also one of the technique, one of the action put in place to guide against base erosion profit shifting. If you want to permanent in a country, you have to have permanent establishment. You don't need to be going to one country to another, go to this, without having your place of origin. Prevent treaty abuse. Prevent treaty abuse. You need to prevent against abuse of double taxation agreement. Double taxation agreement means tax treaty. When two countries sign double taxation agreement, that does not mean the company that reside in those two countries will now misuse the double taxation agreement. That since Nigeria have signed double taxation agreement with the UK, I don't need to pay tax again. No. Addressing the challenges of digital economy. Addressing the challenges of digital economy is one of the forms used by base erosion profit shifting. Addressing the challenges of digital economy. There are some companies, they do not have office in Nigeria or have a representative in Nigeria. They are making a lot of money online from Nigeria environment. Such company is an adoption. So another one, require the taxpayer to disclose their aggressive tax planning arrangement. You need to mandate the taxpayer to give you their tax planning arrangement. Re-examine transfer pricing documentation. You need to regulate transfer pricing. If you want to guide against base erosion profit shifting, as a tax authority, you need to regulate transfer pricing. You need to regulate how companies transfer goods to their subsidiary that is not within a country. So all these are the action plan for base erosion profit shifting. Country by country reporting is also an action plan or measures to guide against base erosion profit shifting. You request the parent company to be preparing a report to you, assuming you are the tax authority of the parent company. You will now be requesting that parent company to prepare a report about their subsidiary in other country to you. That their subsidiary in other country, they will show you in the report, they will show you the amount of income of the subsidiary, the amount of cost of the subsidiary, the amount of tax paid by the subsidiary, the amount of tax you are paying. So that is country by country reporting. What about the content of country by country reporting? Content of country by country reporting. Number one, revenue. Revenue is one of the content of country by country reporting. Profit before income tax. Income tax paid. Current year income tax accrual. Stated capital. Number of employee, tangible assets. All these are the contents of country by country reporting. So that is what we need to talk about base erosion, profit shifting. What you need to know, what are the techniques of base erosion profit shifting? What are the measures? So that is what we need to know on base erosion, profit shifting. The next topic we will look at is costing capitalization.
Sorry, sir. Before we
Good morning. Please, can you
Good
explain
morning.
hybrid mismatch? Good afternoon. It was part of the tools that is used for base erosion and profit sharing.
Okay. Hybrid mismatch. What we mean by that is there are some cost or contribution that subsidiary every year we sign an agreement with parent that is going to be paying the parent company, being the parent company. Why? In order to reduce tax liability of the subsidiary. So hybrid mismatch arrangement, an agreement that they deliberately plan it, arrangement that they deliberately plan, so that every year that cost that subsidiary is paying the parent company will be used to reduce tax liability. That is hybrid mismatch arrangements. So tin capitalization. What is tin capitalization? Like I said, tin capitalization simply means a situation
Excuse me,
whereby,
please.
yes.
Sorry. Please, the base erosion notes, I know it's just 7 pages. That hasn't been shared on the platform. I think
Are
capitalization
you
has been
online
shared, but not
student or is solo student or VI student?
online.
Online. I've not sent it to the group chat.
No. Think capitalization has been sent, but not base erosion.
Okay, I will send it right now. You will see it. I will send it. Now, on tin capitalization. What do you understand by tin capitalization? Tin capitalization, like I said, a situation whereby a company, especially multinational company, is highly geared by debt structure. When you look at the capital structure of a company, when the debt financing is more than equity finance, that means that company is highly geared. That means that company is a tin capitalization company. Why? When debt capital is more than equity capital, the result, the effect in the long run is that that company will pay more interest on loan. So a situation whereby a company is highly geared by debt structure is called thin capitalization. So as a result of that, when a company is highly geared by highly debt structure, they will pay more interest on loan. And that interest on loan that they pay is an excessive interest. So thin capitalization is common among multinational companies, though some local indigenous companies too practice thin capitalization. What is the tax implication of thin capitalization? What is the tax implication of thin capitalization? The tax implication of thin capitalization is that anytime a company has excessive interest, the tax authority is going to restrict the interest. They will restrict the interest, limit the interest to 30% of any before interest depreciation, before interest tax depreciation and amortization. That excessive interest will be disallowed. It is not going to be allowed as an level expenses. It's going to be disallowed. So as a company, you don't need to go and collect loan with excessive interest with the hope of reducing your tax. If you collect loan that have excessive interest, while computing your tax authority will limit your interest to 30% of any before interest and tax. So that is tax implication of thin capitalization. What is when a company practice thin capitalization, what is the result of that thin capitalization? Impact of thin capitalization on company. What impact will thin capitalization bring to a company? Thin capitalization will make a company to shift their profit. It will lead to profit shifting. It means the profit of one company, because of high interest, is going to be shifted to another country that charge minimum tax or lower tax. Erosion of tax base. Thin capitalization will erode profit of an enterprise that's supposed to pay tax. It will make it not to pay tax if a company practices thin capitalization. Tax avoidance. Thin capitalization is a tax avoidance technique too. It is a tax avoidance technique. So it makes you to minimize your tax liability. Encourage fiscal evasion. Encourage fiscal evasion. Since capitalization encourage, sometimes it encourage tax evasion, no? Especially when a company give a loan out with the hope of that loan, the company that collect the loan does not use the loan. The money is just in the company account without using it. and the company want to claim interest. That is fiscal evasion, deliberate act of not paying tax. Rule of tin capitalization. What are the general rules of tin capitalization? Tin capitalization rule apply to company controlled by shareholder who can substitute equity with debt. Evidence when a company is controlled by a single resident party. There are two rules for tin capitalization. Number one rule is, it is called safe harbor rule. Safe harbor rule simply means you define your debt and equity ratio. And the interest you paid on your debt exceeds the ratio, exceeds the set ratio, is not tax deductible. Another rule is any stripping rule. You determine the maximum of interest that may be deducted from your profits. What maximum interest is going to be deducted from your profit? This one is based on 30% of any before interest, tax, depreciation, and amortization. Now, let's look at tin capitalization in Nigeria. When does tin capitalization started in Nigeria? Finance Act 2019 was the one that introduced tin capitalization in Nigeria. Finance Act 2019, which is effective in 2020, is the one that introduced tin capitalization in Nigeria. And that Finance Act, out of the two rules of tin capitalization, Finance Act recommend that we use any stripping rule, which is restriction of interest to 30% of any before interest, tax, and depreciation and amortization. And such interest you restrict, the excess of that interest can be carried forward for maximum of 5 years. The excess of the interest can be carried forward for maximum of 5 years. Question 1. Let's look at a question on tin capitalization. Somebody should read the question for us.
ZYZ Limited was incorporated on August 31st, 2012, and it commenced business on May 31st, 2013. DK Malaysia Limited is a subsidiary in Malaysia. An abstract of the financial statements of ZYZ Limited for the year ended 31st December 2020 is reviewed as follows. Sir, can you scroll up? Hello, sir.
Interest and debt deducted before arriving at accessible profit of 2 million is as follows. Look at the interest we deducted before arriving at accessible profit. We deduct interest of 1,050,000. We also deduct another interest of ₦1, and we also deduct depreciation. Based on the information provided by the company, it was discovered that out of the interest on loan paid to other creditors, 450 was in respect of a loan obtained to generate tax-exempt profits. The managing director of XYZ has approached you as a tax consultant to explain provision of Section 24 of CETA and 7 schedule in respect of interest deductible by Nigeria company. Required: A, compute the interest deductible in the relevant year of assessment. B, compute the tax liability of XYZ Limited. C, explain how excess interest not deducted in the relevant year will be treated. We are giving accessible profits. Anytime we are giving question on think capitalization, we need to first of all get EBITDA, any before interest, tax, depreciation, and amortization. We want to get that. How do we get that? The question said accessible profit after we have deduct interest and depreciation. That means for us to get EBITDA, we need to add back interest and depreciation back to this accessible profit. Accessible profit means net profit. They say net profit after they have deduct interest, they have deduct depreciation. How do we get it back? We need to get, and we need a profit before interest, depreciation, tax, and amortization. That means we need to add back those interests. We need to add it back. After adding it back, our earning before interest and tax is going to be 4,450,000. Our earning before interest and tax will be 4,450,000. When we add 2 million plus 400,000 plus 1,050,000, when we add 3 of them together, plus 1 million naira, you get 4,450,000. Now, what is the first question is interest deductible. Whose interest are we going to deduct according to the law, according to the rule of think capitalization? Anytime we have think capitalization, according to the rule recommended by OECD, which interest are we going to deduct? 30% of what? Earning before
EBITDA.
interest and tax. Now, let's look at out of this interest, which interest is available as an allowable expenses? Which interest is available that we're supposed to deduct? We have two interests here. We have interest coming from DK Malaysia, 1,050,000. Another interest from other creditors, 1 million naira. That means the total interest available is what? 2,050,000. Out of this interest of 2,050,000 available, 450,000 out of it is paid on a loan that generates a tax exempt profit. That means if you obtain a loan to generate a tax exempt profit, that interest on such loan is not allowable, because the profit on such business that you use the loan for is a tax exempt profit. The profit that you use the loan for is a tax exempt profit. That means the interest too accrued on such loan on that tax exempt profit will not be allowed as an allowable expenses. So we need to first of all adjust this interest of 2,050,000. There is one that is disallowed among them. How much was disallowed among 250,000? Interest on tax exempt profit is disallowable expenses, automatic, because the profit, the business that we use such loan that we are paying interest for is a tax exempt business. So the loan too, the interest on the loan too is not going to be allowed. So for us to get the interest available, we need to less 450 from 1 million plus 1,050,000 plus 1 million naira. At the end of the day, we will get 1.6 million. That is the interest that is on grant that we're supposed to allow as an allowable expenses. We will now test for restriction of interest. We will test for restriction of interest. Which interest are we going to deduct as an allowable expenses? Lower of the interest available and the interest restricted. The interest available is 1.6. Interest restricted, 30% of any before interest, tax, depreciation and amortization, 30% of it is going to give us 1,335,000. That 1,335,000, we compare it with interest available. We compare it with interest available for deduction. When we compare it with interest available for deduction, the difference between the two, the lower between the two is what we are going to take. Since restricted interest is lower than the available interest, that means the interest that we are going to allow for tax purpose is going to be the restricted interest, which is 1,335,000. Now, question B said, so our interest deductible is 1,335,000. That is question A. Question B, compute the tax liability of XYZ Limited. How do we compute the tax liability of XYZ Limited? For us to compute the tax liability, we know that any before interest and tax, any before depreciation, interest and tax is 4,450,000. 4,450,000. That is our any before depreciation, interest and tax. Interest is an liable expense. From this profit, we have not deducted interest. The question is, which interest are we going to deduct? Is it the available interest or restricted interest?
Restricted interest.
Restricted interest. So the restricted interest is what we are going to deduct instead of the interest available. That 30% of EBITDA is what we are going to deduct, which means 1,335,000. We will deduct it. We get our adjusted profit. Our adjusted profit is 3,115,000. Less capital allowance. With less capital allowance, there is no capital allowance in the equation. Need. That means our total profit will still remain as adjusted profit, which is 3,115,000. So we are asked to compute tax liability. How do we get our tax liability? Since we know our company income tax is 30% of our total profit, 30% of 3,115,000. It will give us 934,500,000 naira. Our education tax, as at day, which is which year of assessment? 2021 year of assessment. Education tax is still at 2%. 2% of adjusted profit. 2% of 3,115,000. It will give us 62,300. C part of the question. C part of the question said, explain how excess interest not deducted in the relevant year, relevant assessment year will be treated. How will the excess interest? Excess interest simply means the difference between interest available and that restricted interest is the excess interest. How are we going to treat that excess interest? How are we going to treat it?
To be carried forward for a period of 5 years, carry forward up to 5 years.
We will carry it forward for maximum of 5 years. So in this question, how do we get excess interest? Interest available for deduction is 1,600,000. How much interest are we actually deducted while computing tax? That is the restricted interest, 1,335,000. So the difference between the two is the excess interest, 265,000. And this excess interest, we will let them know that it's going to be carried forward for maximum of how many years? 5 years. Any question, any query, any issue on this? Any question? Since there's no question, let's look at question 2. Question 2 is a written. It says explain tin capitalization. That is A. B. Explain brief features of tin capitalization. C. Explain implication of Finance Act 2019 to tin capitalization rule in Nigeria. A part of the question, what is tin capitalization? Tin capitalization is a situation whereby an entity is financed by high level of debt. A situation whereby an entity is highly geared by debt structure compared to equity structure. That is meaning of tin capitalization. What are the features of tin capitalization? One of the features of tin capitalization is an artificial transaction. It is used by a company to practice tax avoidance. Multinational company, they use it to practice tax avoidance. They use it for profit shifting. They use it for base erosion shifting. So those are the features of tin capitalization. What does Finance Act 2019 say about tin capitalization? Tin capitalization was introduced to Nigeria through Finance Act 2019, and it said when we want to determine, we want to restrict rule, we want to restrict interest based on tin capitalization, we need to restrict interest using any stream rule by restricting the interest to 30% of any before depreciation, interest, tax, and amortization. And such interest that we restrict, we can carry it forward for maximum of 5 years. So that is it on this tin capitalization. Any query, any issue, any observation? In the absence of no query, we can now move to task Ivan.
Please, can you please interest on loan paid? Can you explain this particular, what is shown on the screen now?
Which one?
This Diki Malaysia Limited, 1,050,000. Okay, you added it. They are disallowed. Hello, can you hear me?
I'm coming. I want to check it. So which one are we talking about? Are you talking about?
This Diki Malaysia Limited
And
other creditors, you added them back.
I added the two. The company, this company, XYZ, they pay 2 loans. They pay 2 interest on loan. One is paid to who? To their associate called Diki Malaysia. Another interest is paid to who? Other creditor. That means the total interest paid by this company is how much?
2,050,000.
2,050,000. This is supposed to be the available interest. But out of 1 million naira that they pay, 450,000 is for a loan that company used to finance a tax exempt profit. That means that interest on a loan that company used to finance a tax exempt profit, that interest on a loan, automatic, even without think capitalization, is not allowed. When you pay interest on a loan that you borrow to finance a project that you are not going to pay tax on, can you allow that interest as an allowable expenses? No. So that is the reason why we remove 450,000 naira from
No.
this. Do you understand?
Hello.
Eh?
Okay.
What did you say?
Okay. But the interest to Dicky Malaysia. Okay, I understand the 450. Why other creditors is people that are owing? And why was it
Yes.
added back? Because interest is deductible. The two, both for other creditors and for Dicky, 1,050,000.
Why was he what? Added back?
Yes.
I don't understand your question.
That means it is not as an allowable expense. The interest on loan
You know, we
paid.
want to get any before depreciation and interest.
Okay.
Eh?
Yes, sir.
This profit of 2 million, they have already deducted interest from it. I can't hear you very well. The line is breaking.
You said interest, this 2 million. I said they already deducted interest on it. Okay.
Yes, they have already deducted depreciation on it. That is the reason why we add it back. In the question, look at it. They said accessible profit of 2 million. They now give us a note that interest and depreciation deducted before arriving at this accessible profit of 2 million is as follows.
Okay. Okay, sir.
And we need a profit before interest, depreciation, and tax. That is the reason why we have to add it back, so that it will become any before depreciation, interest, and tax.
Okay, okay.
Okay. So that is it on think capitalization. Now, the next area we should look at is called tax haven. Tax what? Haven. Tax haven. Tax haven. Tax haven. What do we understand by tax haven? Tax haven. What do we understand by tax haven? Tax haven is a country or state or territory where taxes are levied at what? A lower rate or not at all. A country that charge lower rate of tax, they are called tax haven country. A country that charge lower rate of tax, they are called tax haven country. A territory with lower rate of tax is a tax haven country. What happened is that most of the company, because they don't want to pay tax, they are now relocating their investment. They are moving their investment to tax haven country. They are moving their investment to tax haven country because they see that tax haven country is a safe country that the investment is safe from tax. They are now shifting their investment to tax haven country. Now let's look at determinants or key factors of tax haven. What factor determine tax haven country? For us to call a country that this country is a tax haven country, what factor are we going to consider before we can regard a country as a tax haven country? Number one determinant is nil or nominal taxes. Such country that is called tax haven country, they charge nil taxes or they charge lower rate of tax. This factor is recommended by OECD. OECD said there are three key factors that we use to determine whether a country is a tax haven or not. Number one is nil or nominal taxes. Nil or nominal taxes. Such country, they charge nil taxes. They don't charge tax at all, or they charge tax at a lower rate. Number next is protection of personal financial information. Such country that practice tax haven, they normally protect information of the taxpayer in that country. Do you understand? They are not cooperating with other tax authority. They don't share information. They do not practice OEI. OEI means they do not practice AEI. AEI means automatic exchange of information. They don't exchange information with any tax liability, any tax authority in other country. Maintain confidentiality of taxpayer history. The company in their territory, they protect their information. They don't share it with another country or another tax authority. Another determinant, lack of transparency. Most of these companies that practice tax country that engage in tax haven, most of the information that they give foreign tax authority is not transparent. They don't give transparent information because they would like to protect their taxpayer. They don't want other country to come and charge their taxpayer. They maintain the secret on the financial affair of their taxpayer. Classification of tax haven. How do we
excuse me.
Okay.
Excuse me. Does it mean that countries that practice this tax haven, they don't sign tax treaties with other companies, with other countries?
They don't sign. They don't sign.
Okay.
Because no, why will a country practice tax haven? Can you ask yourself why will a country practice tax haven? Some of these countries that practice tax haven, they believe tax is not a source of revenue. Some of them, they have natural resources like oil, like gold, like mining. So they don't want to be collecting tax. Some of them, maybe because of religion, like a Muslim now, they have their taxes that they collect. That one is called zakat. every Muslim must pay zakat in a year. So most of these countries believe that if somebody has paid zakat already, why do you want him to come and be paying the corporate taxes, company income tax, education tax? Because of religion reason or cultural reason. That is the reason why they practice tax haven. Or some of them, they are using it to attract foreign investment. Like Dubai now. Look at the number of industry in Dubai. Big giant company. They are now moving to Dubai. Why? Because they believe that the tax that they charge them in Dubai is too low. They are now relocating their investment to Dubai. So Dubai may be using that as a strategy to attract more investors. That when we have too much of investor, our country will grow, rather than telling them to come and pay tax. You know, every company, individual, we like free thing. When they heard that Dubai is not collecting tax or Dubai is charging lower tax, they would like to go and invest in Dubai so that they pay lower tax. And in the long run, it is the Dubai citizen, Dubai government that will be benefiting from such investments. Do you understand? So those are some of the reasons. So classification of tax haven. Number one classification, primary tax haven. Primary what? Tax haven. Primary tax haven simply means a country where subsidiary is located, where subsidiaries shift their profits to. What we mean by this is the subsidiary of a company is located in this tax haven. Parent company is now mandating all other subsidiaries their profits to this country that
Those
they
not allowed in this one.
that practice this tax haven.
Because I never choose to come out from both.
Because you manage the room for you this week.
Another type of tax haven, please let's move our audio. Another type of tax haven is, we call it semi-tax haven. This one, they produce goods for sale primarily outside the boundary to encourage economic growth. In this semi-tax haven,
yes, that's it.
That tax haven country, they create that tax haven country, they create a free trade zone where most of the company can come and do a trade, and such kind of trade is exempted from tax. Semi-tax haven, we have it in Nigeria. We have export free trade zone in Nigeria, export processing zone. We have free trade zone in Nigeria. When a company located in free trade zone, they enjoy some tax incentive. It's a tax haven. We have that in Nigeria too. Export processing zone. There are some companies that we have in Nigeria. They're normally located in Lekki export processing zone. Such company, when they produce goods, when they export it out of the country, the profit on such goods is exempted from tax. That is semi-tax haven. So, for the sake of time, let's look at method used to practice tax haven. What are those methods used to practice tax haven? Permanent residency. Permanent residency is one of the methods. A country can give individual permanent resident, wealthy individual, somebody like Bill Gates, Facebook, all those wealthy individual.
Is it personal? Sorry, sir. Is it personal residency or permanent?
Personal residency. Sorry, personal residency. Personal residency. They will give them to become a resident of their country. Dubai will invite some rich, wealthy individual. Come and become our relevant. Relocated to our country. We will give you a citizen of our country. You will become our citizen. And when we become our citizen, all your investment will not be taxed. Another one, corporate residency. They will invite a company to come and establish in their country with the hope of not paying tax. They will say, if you come, we give you guarantee, you are not going to pay tax. Another one, asset holding. Asset holding. All this one means is that a subsidiary, his parent company will be in the tax haven country, and his parent company will now lease the asset to the subsidiary. That asset the parent company leases to the subsidiary, to the different subsidiary. That different subsidiary will be paying tax on that, will be paying leased rental cost on that asset. That rental cost is an income to the parent company. Since the parent company is located in the tax haven, such income will be exempted from tax. So asset holding. Now, we have three methods used to practice tax haven: permanent, personal residency, corporate residency, and asset holding. Permanent residency, corporate residency, and what? Asset holding. Now, what are the measures put in place to curb tax haven? What measure do we put in place to curb tax haven? What are those measures do we put in place to curb tax haven? Number one measure put in place to curb tax haven is attributing the income or gain of the company or trust in the tax haven to a taxpayer in high tax jurisdiction on an arising basis. What we mean by that is that country that practice, that company that practice tax haven, that is located in the tax haven country, when they come and do business in a non-tax haven country, we give them attributable income. If they don't want to disclose their income, we give them assumed income, and we charge them tax on those assumed income. We charge them tax at source. Before they take the income to their tax haven country, we charge those income at source. transfer. We need to introduce transfer pricing rule. Transfer pricing rule. We need to introduce it on some of the income far from country. So that if they want to transfer those goods at a profit margin, we will regulate it. The cost that they are going to charge will be reduced so that the profit going to reduce since they are not paying tax. Another one, restriction of deductible or imposition of withholding tax when payments are made to offshore recipients. We need to use thin capitalization rule. If you see that one parent company is located in the tax haven, they now borrow the subsidiary money. They are not charging interest. That interest that they are charging on that subsidiary, since we know that the parent company is not paying tax on those interests, and they want to allow it as an allowable expenses to the subsidiary, we should disallow it. We need to fight those countries that practice tax haven. All other non-tax haven countries, they will gather together under OECD. They will look at what measure they can do to fight this country that is practicing tax haven country. Because to they don't want tax to develop. They don't want tax to be one of the main sources of government revenue. Their advocacy of non-payment of tax. So we countries that we depend on tax as our means of revenue, we need to gather together and fight those tax haven countries with policy. We can use another policy we can use is restriction of trade barrier from tax haven country. We will not be dealing with those tax haven countries. We will impose trade barrier on them. We place embargo on them that we will not be having business with them since they are not charging tax or they are charging lower tax. That is unreasonable. Signing of tax treaties. We that we are charging tax, we need to sign double taxation agreement among ourselves. Reduction of tax rate. We that we are charging tax too, since we know some companies are not charging tax, in order to attract investment, we too we can reduce our tax rate. We too should not let our countries too should not let our tax rate to be increased too much, so that people will not be carrying the investment. Because we know tax is competition now. Tax is what? Competition. When you are charging them too much of tax, they will relocate their investment to tax haven. Once you know that these people are moving out from your country, you need to reduce your tax rate so that they can stay. They will not go to that tax haven country that they will not even charge them tax, or they will charge them one stupid rate of tax. Reduce rate of tax. In a nutshell, the major measure that can put in place to curb tax haven is trade barrier against tax haven country or embargo against tax haven country. We need to place those tax haven countries. We need to strict trade barrier on them. USA, the giant company, Germany, the giant country, UK, they should not be doing business with tax haven country. Nigeria too, we should not be doing business with tax haven country. Because we observe that day by day, most of the multinational companies now, they are relocating their investment from developing country, from developed country to this tax haven country, because they see tax haven country as an harbor to their investments. Do we understand? Do we understand? So all these are the measures put in place to curb tax haven. What are the examples of countries that practice tax haven? Those countries that practice tax haven. Look at them. Number one, Switzerland, Netherlands, Jersey, Bermuda. We have British Virgin Islands. We have Malaysia. You have UAE. You have Dubai. There are so many countries. Nowadays, they are now engaging in tax haven. They don't want to be charging tax, or they are charging tax at a reduced level so that people can relocate their investment to it. So my practical argument is, as a student, do you support tax haven or not? Those countries that practice tax haven, are you for them or you are against them? Let's talk practically. I need a response. Some people, I was reading an article, some people write in support of this tax haven country. They said, this tax haven country you are talking about, they are using their technique. They are using tax haven. They call it as a tax competition, harmful tax competition. Tax haven is a technique of harmful tax competition. Do you agree with me? Tax haven is a technique of harmful tax competition. Countries that engage in tax haven, they are using it as an harmful tax competition to other countries, because their country will be developed. There will be a lot of development, investment in their country in the long run. And when there is investment in the country, they will receive more money. They will generate more money aside from collection of tax. So, ladies and gentlemen, as related to tax haven, it has been like 4 diets ago, a question on tax haven come out. If I were you look at last diet, what question come out on international tax? Who have reviewed past question? What question come out on international tax last diet? Last 2 diet, which question come out? But this time around, it has been long tax haven question come out. So please, let's know more on tax haven. Let's know more on tax haven. At least let's know 10 countries that practice tax haven. Let's know measure used to curb tax haven. Let's know techniques used to practice tax haven. Let's know factors that determine tax haven. Please, let's take more attention to this. Any question, any issue, any observation? Any question? Any question? So in the absence of no question, we can call it a day. Thank you for having me. Have a nice day.
Thank you too.
Thank you, sir.